Is $1 trillion in annual oil trade about to abandon the US dollar? Iran is now selling 1.7 million barrels a day to China, and not a single one is priced in dollars. This was unthinkable just a decade ago. The majority of international oil sales were in dollars, with the US as the clear winner. But that's changing fast. The petrodollar system, where oil producers sell their crude to buyers who must pay in dollars, has been around since 1974. It was a clever move by the US, allowing them to export dollars as well as goods and services. In exchange for military protection and access to new markets, Saudi Arabia agreed to price its oil exclusively in dollars. This created a self-sustaining cycle. Countries needed dollars to buy oil, so they held on to them, which kept their value high. But today, that system is under threat. As we'll explore in this video series, a rising yuan and shifting global alliances are eroding the petrodollar's dominance. So what set this petrodollar system in motion? To understand that, we need to go back to a famous meeting between King Faisal of Saudi Arabia and Henry Kissinger at the State Department in Washington, D.C. in November 1974. This was no ordinary handshake. It marked a secret deal that created the petrodollar system, which would go on to shape global oil trade for decades. At the time, the United States had become increasingly dependent on imported oil, while Saudi Arabia's oil exports were booming. The two nations needed each other. Kissinger, who was then U.S. Secretary of State, wanted to secure a reliable supply of oil and ensure American access to Middle Eastern markets. King Faisal, for his part, sought long-term economic stability and security guarantees for his nation. The deal they struck was simple yet profound. In exchange for military protection and U.S. guarantees on Saudi Arabia's borders, the kingdom would price its oil sales in dollars instead of gold or other currencies. This created a massive demand for dollars around the world, as countries had to buy dollars to pay for their oil imports. The petrodollar system was born. But here is the thing. This wasn't just an economic agreement. It also had significant geopolitical implications. By linking oil prices to the dollar, the United States gained immense influence over global trade and finance. Other nations were forced to peg their currencies to the dollar or risk being cut off from vital oil supplies. The petrodollar system became a cornerstone of American power in the world. Over time, this arrangement has been tweaked and expanded upon, but its core structure remains intact. Today, as we explore how the war with Iran is changing the petrodollar system, it's essential to understand the historical context that created this complex web of economic and military relationships. So how does this petrodollar system actually work? Well, imagine a major oil exporter like Saudi Arabia selling its crude to another country, let's say Japan. The seller gets paid in dollars. But here's the thing, those dollars are not just any dollars, they're petrodollars. When these dollars flow into a foreign central bank, like the Bank of China or the Reserve Bank of India, they don't just sit there collecting dust. No, they get deposited and then recycled back into the global financial system as loans to other countries. And that's where it gets really interesting. These petrodollars are not just financing oil imports, they're also funding all sorts of other investments in emerging markets and developing economies. But what happens when these dollars start to lose their value? That's right, folks. The very same petrodollar that was once the global reserve currency is now facing a threat from its own success. As emerging market currencies like the yuan and the renminbi continue to rise in importance, the share of the petrodollar in global trade and finance is slowly but surely declining. So what does this mean for us? Well, it means that the old rules of international trade and finance are changing. The petrodollar system has been around for over 40 years, but its grip on the global economy is slowly loosening. And as we'll explore later in this video, This could have big implications for the future of oil trade and even geopolitics. So let's get concrete with an example of how this shift away from petrodollars is playing out in practice. In recent years, China has been making yuan-for-oil deals with several major oil exporters, including Iran, Russia, and Saudi Arabia. These agreements involve the Chinese central bank buying oil directly from these countries, settling the transactions in yuan rather than dollars. This is a big deal for the petrodollar system, because it means that these countries are no longer pegging their currencies to the dollar. They're effectively creating an alternative currency reserve unit, one that's backed by oil reserves rather than U.S. Treasury bonds. The implications of this trend are significant. For one thing, it reduces the demand for dollars in international trade, which means less pressure on the U.S. economy and a smaller petrodollar share of global GDP. But it also creates new risks for the dollar-based financial system, as countries like China and Russia accumulate more yuan reserves and potentially start using them to challenge the dollar's dominance. Let's take a look at an example of how this is playing out in practice. Last year, Saudi Arabia sold $2 billion worth of oil to China, settling the transaction entirely in yuan. This was a major shift for the kingdom, which had previously been a stalwart defender of the petrodollar system. But here's the thing. This deal is not just about Saudi Arabia and China. It's also about Iran, Russia, and other countries that are increasingly looking to diversify their reserves away from dollars. As more countries follow suit, we can expect the petrodollar system to come under even greater pressure. So we've established that a declining petrodollar share means something significant has changed in global oil trade. But what exactly happens when a country's currency is no longer used to price its own main export? The immediate consequence is rising U.S. borrowing costs. Think about it like this. The United States issues treasury bonds to finance its budget deficit and foreign wars, including the ongoing war with Iran. Those bonds are denominated in dollars, and their value is tied directly to demand for the petrodollar. When the petrodollar share falls, it's like a signal that investors have lost confidence in the dollar. As a result, interest rates on those treasury bonds rise. This means the United States has to pay more to borrow money from abroad. That increases the burden of its national debt and makes it harder for Washington to finance future wars or economic stimulus packages. This is not just an economic concern, but also a potential source of global instability. A weaker dollar can trigger a currency war, as other countries try to defend their own currencies against the perceived strength of other nations. This has happened before in 2015, when China allowed its yuan to depreciate against the US dollar. We'll explore more of these implications and consequences in future chapters. But for now, let's focus on why a falling petrodollar share is so significant in the context of global economic shifts. So what does the future of oil trade look like? The petrodollar's dominance is clearly at risk, but so far we've explored a few potential replacements in piecemeal fashion: yuan-for-oil deals and central bank digital currencies, CBDCs. Today, let's step back and imagine two other alternatives that could reshape the entire system: gold-backed BRICS settlements and CBDCs. The idea of a gold-backed BRICS settlement is straightforward. All member countries agree to settle trade balances between each other in gold, rather than dollars. This would give emerging markets like China and India more control over the global financial system and reduce their reliance on the US dollar. But here's a crucial point that often gets missed. BRICS is not just about creating an alternative to the petrodollar. It's also about challenging Western dominance of the global monetary order. And China has already made significant strides in this direction with its Belt and Road Initiative, BRI, which aims to connect Asia with Africa and Europe via massive infrastructure projects. Now let's talk CBDCs, a concept that may sound like science fiction, but is actually gaining traction around the world. A central bank digital currency would allow governments to issue their own digital currencies, allowing for faster, cheaper transactions and giving central banks more control over monetary policy. But here's the thing. While some see CBDCs as a threat to traditional fiat money, others believe they could help stabilize the global financial system by reducing reliance on private currencies like Bitcoin or even the US dollar itself. So what will happen? Will BRICS create a new gold standard, or will CBDCs revolutionize international trade and finance? Or perhaps something entirely different will emerge. Chaos, that is. The truth is, we don't know yet how this all plays out. But one thing's certain. The future of oil trade will be decided by a complex interplay between geopolitics, economics, and technology. And as investors, policymakers, or simply curious observers, it's our job to stay informed and adapt to these changes as they unfold. Word count 420. So how will the looming war with Iran accelerate the shift away from the petrodollar system? To understand this, let's start with the current situation. The relationship between the US and Iran has been deteriorating for years, with both sides engaging in a game of cat and mouse. But what does this have to do with the petrodollar system? Well, the petrodollar system is built on the idea that oil is traded for dollars. This means that countries like Saudi Arabia and Iraq sell their oil for US dollars, which are then used to buy American goods or invested in US assets. However, with the rise of rival powers like China and Russia, this system is under threat. And now, with tensions between the US and Iran escalating, we may see a major shift in the way oil is traded. The war with Iran would likely disrupt global oil markets, leading to higher prices and increased instability. This could accelerate the shift away from the petrodollar system, as countries begin to look for alternative currencies to trade their oil. But what are the implications of this shift? How will it affect the global economy and the role of the US dollar? To understand this, we need to take a step back and examine the history of the petrodollar system. The origins of the petrodollar system date back to 1974, when Saudi Arabia and the US made a secret agreement that would change the course of global finance forever.